Hi guys, interest rates keep going up. My gosh, they almost doubled from a year ago. So lenders are being very creative and coming up with new options for you, the consumer or the buyer, to consider. One of the newest terms are a 2-by-1 or 3-by-1 buy down. So I invited Brandon to give us an insight on these different loan options. So stay tuned. All right. Well, we got together today because I had some questions for Brandon with all this fuss and all these different mortgage products out there, and I was hoping he would give us some answers to some questions I have. So to start out, Brandon, I know that those interest rates just jumped again slightly a little bit. They keep going down and up. I mean, that is just crazy, isn't it?
It is, yeah. I mean, it's definitely something that a lot of the buyers in the current market aren't used to, because a lot of today's buyers were only in the market for the last couple of years. And as you know, interest rates for the last couple of years were abnormally low due to the pandemic, right? So rates in the twos or the threes, those are just not realistic interest rates. We took advantage of them while we could. And anyone who bought a home during that time period who got those rates is extremely lucky. But someone looking to buy right now and in the near future should not expect to see rates that low. And if that's what they're waiting on before they buy a home, they're going to be waiting forever. I mean, I'm sure that no one wants another pandemic like what we experienced, 2020 throughout 2021. But that's what would have to happen more than likely to see rates that low. Now, interest rates currently are in the low to mid sixes, so they're not terrible. Those are more normalized rates. However, rates are expected to drop down coming into 2023, most likely the middle or end of next year. We'll probably see rates in the mid fours to the low fives. But rates in the low to mid sixes are really not bad interest rates. As long as you can afford the monthly payment, which is the important part, right? The rate's important, but it's really the payment that someone's concerned with. So as long as the monthly payment is affordable for that home buyer, then that's what really matters. If rates drop, right, in the future and they bought their home today, we can always refinance them to get them a lower interest rate. But if they can find the right house currently and they qualify to buy the home and they can afford the payment on that home based on where rates are now, then I think they should make a move on it. I don't think they should let rates keep them out of the market.
Right, because, it's always like, I mean, I have a perfect example. I had a client who bought an investment property about 5 months ago, and he was able to get a 5% ARM, 10-year ARM. That same loan product now is 6.5% as an ARM, but now with the prices shifting slightly, his payments are probably just same equally to what they would be if he had just waited and bought now. So I think it's all a number game.
Yeah, for sure. I mean, listen, home prices can change, which will affect your payment the same way rates can change. So I guess it comes down to, is it better to wait to potentially get a lower interest rate but pay more for a house, or is it better to buy now, pay a little bit less for the house at a higher interest rate? I think paying less for the house with less competition at the higher interest rate makes more sense, because like I mentioned, you can always refinance and get the lower interest rate once one becomes available. But that same house is not going to stay at the lower price forever. As soon as rates come down, anyone who's been waiting to buy because rates are quote unquote high is going to come back in the market. And it's essentially supply and demand. The more demand that there is and the less supply that there is, it's going to drive prices up again. So as soon as those rates are down, it increases the demand, and it's going to be the same houses on the market, same number of houses, we should say, more than likely on the market, which more people competing for the fewer homes is going to drive those prices up again. And that's what we saw over the last couple of years. Rates were so low, it created more demand for people to buy, but inventory wasn't moving at the same rate as the demand, and therefore the prices shot up. There was less homes to choose from, so those sellers can ask for higher prices because they know they can move them to these buyers that were in the market, which there was just a flood of buyers, right? There's less right now, which is why home prices aren't skyrocketing like they were for the last couple of years.
Right. No, I agree with you. It's a direct correlation to supply and demand. And, November and December, generally speaking, here, I mean, the Panhandle, I know you're in the South Florida area, but our market is usually slow this time of the year. So it is always a good time to be a buyer because especially now with the sellers being a little bit on the fence and their homes have been sitting for a little bit longer, they are starting to offer some incentives. So that's what I was going to talk to you about next. I have, for example, listing right now, and the seller is offering a $10,000 closing credit or a buy down, either a 2x1 or so. Can you elaborate a little bit on those different products and which one do you think is the best one to use right now?
Sure. So it really depends on your buyer for the specific home and how long they plan to keep that home. And if they have the cash right now available to go toward their closing costs or if they need the cash, right? Because that $10,000 at the end of the day, whether it's applied as a closing cost credit, meaning it covers their costs at the time of closing or a large portion of them, or that same $10,000 is given as a 2-1 buy down, like you mentioned, where it buys the rate down for the first couple of years of the mortgage, it's $10,000 whichever way you slice it, right? Because that 2-1 buy down cost, well, let's assume it's the 10,000. The credit the seller needs to give, I should say, for the 2-1 buy down is equal to the savings over the first 2 years. So let's say it saves them $10,000 in interest payments over the first 2 years. Well, that $10,000 is the same as $10,000 at the time of closing, right? It's $10,000 either way. So as far as a buyer determining, do I want $10,000 toward my closing costs or do I want the $10,000 towards my 2-1 buy down? That person needs to decide if they would prefer to have a lower monthly payment for the first couple of years, or if they'd rather bring less money to the closing table, because it's the same money no matter which way we slice it. I don't really recommend doing permanent buy downs right now. That's where you buy the interest rate down for the life of the loan. And this goes back to what we were talking about initially. When rates do drop, because they're expected to within the next 18 months, anyone who gets their mortgage, even at a bought down rate today, is going to lose out on a portion of that credit that was used to buy the rate down. Because on a traditional rate buy down, all the cost for that interest rate buy down is used up immediately. So if you spend $10,000 to buy your rate down from 6.5, let's say it gets you down to 5.75, hypothetically. If you were to refinance 2 months into having that loan, that 10 grand you spent for the lower rate is gone, right? You spent it already. The benefit of the temporary buy downs, like a 2-1 buy down, is that any unused portion of the credit you receive from the seller for the buy down still belongs to you as the borrower. And so when you refinance, you actually get the prorated portion of what was given to you back to go toward your closing costs or to pay your principal balance down. So if you got a $10,000 credit and you refinance 12 months in to the mortgage, that means you would have roughly, let's just call it $4,000 left from that credit, right? That $4,000 would be applied toward your settlement costs on the refinance, which should pretty much cover any third-party costs like title and government charges. I know that we don't charge any lender fees on refinances, so it becomes a free refinance to that person. So I'm recommending these temporary buy downs just because you get the full benefit of the credit that you're receiving versus doing a long-term buy down if you were doing a comparison of those two. As far as the closing costs versus using it for the buy down, like I said, are you more concerned with how much money you need to bring to the closing table, right? Or are you okay bringing the money to the closing table and just having a lower payment over the first couple of years? You know, as far as the money to closing, you might want to maybe make some repairs or updates to the house post-closing, and you need that extra $10,000 available. Well, then it makes more sense to take it as a credit toward closing costs. But if that's not something that's a concern to you, then of course, just take it over the first couple of years, have a lower monthly payment, and refinance when rates do drop.
So what do you think about your ARMs? Do you just still feel like they're not as good, like a 5-year ARM, or?
We haven't really been doing any. I haven't done an ARM in a couple of years. We were doing, I would say, right during when the pandemic first hit. That's the last time we were really doing ARMs because rates came down so much that they kind of fell to the wayside. And now with these temporary buy down options, you're getting a rate that's even lower than what you get on an ARM. Right. You know, if you're doing, we do a 1-0 buy down, a 2-1 buy down, and a 3-2-1 buy down. And for those that are watching this that aren't familiar with what that is, A 1.0 buy down means your rate is 1% lower for the first year of the mortgage. A 2.1 means it's 2% lower year one, 1% lower year two, and a 3.2.1 is 3% lower year one, 2% lower year two, 1% lower year three. So let's just say that market rate 6.5. A 3.2.1 buy down will give you a 3.5 the first year, 4.5 the second year. And like I mentioned a few times at this point, you're likely going to refinance within the next 18, call it 24 months. You'll never even get to the 5.5 or 6.5% interest rate, right? So if you're going to do an ARM, as an example, maybe a 5-year ARM, and the rate on that, let's call it, is 5.75%, well, you'll probably refinance out of that ARM anyway when rates go down to 5, right? So you're not going to have that ARM very long. You're better off paying even less interest with these temporary buy downs because you're still going to get a rate that's at least a full % lower than what you get in an ARM today.
That makes sense. And if you do, if the rates do drop like you are thinking there might be the end of next year, and you do a 3.1 buy down, so how would that work then if you decide to refinance in the end of next year? Is that money that you're
right
holding,
now?
Can you use it then towards the closing, or is that something you would lose then?
No, it works the same way as a 2.1 buy down. So any of the temporary buy downs, you get that money back. And so as long as you refinance within the buy down period, so on a 2.1 buy down, if you refinance within the first 24 months, so the first 2 years, whatever's left over goes toward your closing costs. A 3.2.1 buy down works the same way, but you have a 36-month window in which if you refinance, you get that money back. And the reason it works that way, and a lot of people don't realize what's happening if they are familiar with these temporary buy downs, it's not necessarily that your rate is actually lower, right? In theory, that's the idea, but it's that your payment is being subsidized every single month by this credit the seller gave you. So to determine how much that subsidy is on a monthly basis is they take, let's just do an example, a 6.5% interest rate, what that principal and interest payment would be. Then they take a 3.5% and what that principal and interest would be. And whatever the difference between the two payments is, let's call it $800, right? Hypothetically, that's how much money is being subsidized every month for the first year for the temporary buy down. Then year two, it would be 6.5 versus 4.5, and whatever that amount would be, it's called $500. That's what's subsidized every single. So that's why there's still money left versus a traditional rate buy down where the money's all used up at one time. That money's just sitting there. It's like an escrow account for tax, the same way tax and insurance have an escrow account. Same thing with the buy down money. It's sitting there and it belongs to you. If you sold the house within that time period, paid off the loan, you'd get the money back as well. It would pay down your principal balance at that point in time. So the money belongs to the borrower in the case of a temporary buy down.
Okay, so now is that applicable to any type of loan, VA, FHA, conventional, or is it limited to a certain one? Even USDA and all those, anything?
No, not USDA, VA, FHA, and conventional loans. You can do the buy downs on. On FHA and VA, you can only do a 2.1 buy down would be the maximum. So a 1.0 or a 2.1. On a conventional loan, you can do a 3.2.1, 2.1, or a 1.0. But those buy downs get more expensive the longer the buy down. So a 3.2.1 buy down is the most expensive. On a $450,000 loan, let's call it, you're probably looking at close to $25,000 credit that you need. And the 3.2.1 only works if someone's putting at least 10% down. The 2.1 and the 1.0 on a conventional loan, you have to put at least 3% down as a first-time buyer, 5% down if you've owned a home in the last 3 years, right, on a primary. So that's very important. So you can do a 3.2.1 with a 10% down payment or more if you're doing a conventional loan. And that's because that money the seller's giving counts toward what are known as interested party contributions. And so when you're putting less than 10% down on a primary home, those interested party contributions are capped at 3%. However, once you put 10% down, that can go up to 6%. And since that credit that would be needed from the seller exceeds 3%, you have to put the 10% down. So that way it falls within the allowable limits for the interested party contributions.
Interesting. It sounds complicated at first, but then once you understand it, it becomes a little easier.
Yeah, exactly. Right? I mean, a lot of the things we're talking about aren't things that the buyer needs to know the details of, but I'd rather share the information why it is what it is. But that's what, it's up for us as the lender and you as the agent to know more about it, so we know how to structure deals for our buyers.
Right. And like you mentioned, and I think that's really the crucial point, is it's different for every single buyer because we all have different, situations, a different cash flow. And so you got to make sure you match the right product to the right situation. I think that's really important.
100%.
Yeah.
It's true.
Well, good. Well, Brendan, I think this was awesome. I really appreciate your time today and giving us a little bit of a background on all these different loan options because this is all new. I mean, it's new to me, I didn't deal with a 2x1 buy down 2 years ago. So
it's right. Yeah, the rate would be 0.
Yeah, wouldn't that be something? You start out at 0. How that would have probably been fine. Now, does every lender, the criteria are pretty much the same, or do they vary depending on who you're working with?
Yeah, the criteria should be pretty much the same across the board as far as what's required and how you qualify for these types of things. What could vary from one to the other is some lenders don't offer a 3-2-1. Some might only do a 2-1. Something that is very, very important to keep in mind is that most of these temporary buy downs that are offered by lenders have to be paid for in full by the seller. Right? So they're seller buy downs, meaning that the seller needs to give a large enough credit to cover the entire buy down, not a portion of it, right? It has to cover the entire thing. However, I know that we also offer a lender buy down and a hybrid buy down. So the lender buy down means that we can actually build the buy down into the interest rate. So essentially cover the cost of the buy down without necessarily having to get the seller to cover the full cost of the buy down, right? Because maybe you can't work that out on a specific property. The hybrid buy down allows us to combine a credit from the seller along with us building it into the rate. So maybe it's $10,000 for the buy down, but the seller will only give $6,000. We can build the additional $4,000 into the interest rate and therefore cover the gap in order to get the buy down in place. So that's a huge advantage that we have over a lot of different lenders out there right now, where they're only offering the seller buy downs, right? Seller buy downs, where we're offering the hybrid. The hybrid, more so than the lender, is a popular product just because at least we can cover a portion and the seller covers a portion.
Well, and Brendan, you already answered my question, but you said you think you're pretty optimistic that we're looking at maybe a 4.5, a lower interest rates at the end of 2023?
Yeah, I'm hoping sooner than that. So this isn't just based on me saying it and what I think. I'm actually, from information that I gather from individuals who do that for a living. So the chief economist for Fannie Mae is projecting that rates are going to be in the mid-4s by third quarter of next year. I think that's a pretty good go-to for that information. He's been on point year after year with his projections. I mean, this year's a little bit different going into next, but I would imagine that he's going to be pretty in line with what we should expect. I mean, just so you do know, rates dropped by 0.75% within the last 2 weeks, just based on the fact that inflation is down a fraction of a percent, right? Any positive news like that, we tend to see a positive outcome when it comes to the interest rates. That's a huge swing. I mean, a buyer who was getting a 7.25 2 weeks ago is getting a 6.5 today. That's pretty substantial.
That is, yeah, I saw that. And it's also very, sometimes, that's what you have to remember when you're negotiating a contract, because you can't lock in a rate, or can you, until you have a written contract. And if those rates are, today, let's say they are 6.25 and you are negotiating a contract, it takes you 3 days, and then they all of a sudden jump to 6.75 or 7, then that is,
changes things.
Yeah, changes the timing, doesn't it?
It does. I mean, so to your question, as far as locking, so standard practice is, yes, we don't lock an interest rate till you're under contract, have a specific closing date, because there's not an infinite time period that a rate remains locked for, right? It's a fixed period of time. We can do custom rate lock ranges. So if you have a 20-day closing, we can do a 20-day rate lock. Most lenders do it in 15-day increments. So 15-day, 30-day, 45-day. I would say the most common is a 30-day lock, meaning that your rate is locked for 30 days from the time you lock it, right? So it usually gives you enough time to close because most contracts are 30 days or less nowadays, right? When rates were really jumping up a lot, which was between April of 2022 this year and call it August of this year, rates moved a lot, right? They went from in the 3s all the way up to in the 6s very quickly.
Mm-hmm.
And during that early period, so April, May, we were seeing a lot of rate locks prior to finding a home. We call that a lock and shop program. That's where we'll lock someone's interest rate for a period of time prior to them actually, finding a house. Now, when you do that, you're locking at a higher rate than what the rate is that specific day.
Mm-hmm.
But the point is, you're locking it for up to 6 months with the intent that rates are going to be higher 4 months or 6 months out from they were then. So if we're locking 0.5%, let's say rates at that time were 4, but we're locking at 4.5, right? Which is 0.5% higher than the market was that day. But who knows? Rates go to 7 like they did, and you're still locked at 4.5. Well, that's a pretty good deal, right? So it's less popular right this moment because rates are not really jumping up like that. But in markets where you see those large spikes in very short periods of time, that becomes more popular. What it requires, though, is that the borrower gives a 0.5% fee up front to do it, but they get that back toward their closing costs at the time of closing. So if they don't close, they lose that money.
Mm-hmm.
But so they have to make a commitment on their part. Hey, here, I'm willing to do this. I'm committing that I'm going to move forward on this loan at this rate. And if they don't, like I said, then they lose that fee that they paid for it. Otherwise, it's applied toward their closing costs when they do close.
Okay, so one last question I have that just crossed my mind. When you were talking about it, I do a monthly market update, and when I'm looking at the data and the inventory, February, March, April, that's exactly when the market starts shifting, and that's exactly when the interest rates start changing too. So I think taking a look at the interest rates always is a direct correlation, but then each market is very different. It even in the Panhandle where I am, it can change from one area to another, because it all depends on who your buyers are and again what the inventory and the location is, and of course the interest rates, a direct correlation. But if the interest rates do drop to 4%, and let's say you have your rate locked in at 6, at what point do you recommend refinancing?
So I recommend refinancing if you can determine you're going to save enough money to cover the cost of the refinance
Mm-hmm.
within 36 months, assuming you're going to keep the property at least that long, right? So that's always an important question on any refinance that we like to ask our borrowers. How long do you see yourself staying in the property?
Mm-hmm.
If someone tells me they're going to stay in the property 12 months, and we look at a refinance and we say, okay, a refinance is going to save you $300 per month, but it's going to cost $6,000, just as an example, right? If we take 300 divided into the 6,000, so the savings divided into the cost, in that example, it gives us 20, which is the number of months it would take to recoup,
Mm-hmm.
right? If they're selling in 12, I wouldn't recommend refinancing because they're losing money by refinancing because it's going to take them 20 months to save money, but they're selling in 12. That means there's no benefit to them. Maybe on a monthly basis, they'll feel the benefit based on the savings, but overall cost, there was no savings. It was only an additional cost to them.
Gotcha.
But if someone tells me I'm keeping the property for the next 5 years and we're going to refinance and they're saving $300 a month and it's costing $6,000, well, that makes sense because they're going to be there at least 60 months. They're recouping their cost in 20, which means they're saving money for 40 months, right? Which is $12,000 at $300 a month. So that's a great option for that particular person. But to go back, that's how we determine if it makes sense to refinance. We find out how long they plan to keep the property or stay in the property, what they're going to save monthly and what it's going to cost them. And if they can recoup the cost within the time period they plan to stay in the home, then it makes sense. If they cannot, then it doesn't make sense.
Well, that sounds
so there's no
good.
real rule of thumb, right? There's no people
Yeah,
say,
I know.
I can't save at least
I think you're absolutely
people-
right. that's why you have to really look at each situation individually. And what works for this one
100%.
person may not be the best thing for this one. But listen, Brandon, I really appreciate your time. And if you want to reach out to Brandon, I'm going to attach the link below and his contact information and his phone number. So you can see it if you have any questions about him. And you tell us just quickly, where do you help buyers, just in Florida, or what is your...
I would say 95%, maybe even more of the business I do is in the state of Florida, just because that's where I'm located. But I am licensed in Tennessee, Virginia, Colorado, and Texas as well. We do business out there, but it's more on a case-by-case basis. Florida is really where the brunt of our business comes from, just because it's a relationship business, and I have relationships with agents throughout the state. It's kind of hard to have the same relationships out of state with agents. So that's really the primary reason. But like Sabina said, if anyone watching this has any questions for me on anything mortgage related, I'm very happy to answer them. You can always reach out to me with the contact information Sabina provides below, and go from there.
And this is Brandon with Reach Home Loans. All right, Brandon. Well, thank you so much for your time, and I really appreciate you. And we'll talk soon.
Appreciate it. Thank you. Have
Thank
a good
you.
one.
Bye-bye.